Hey everyone, and welcome back to another video for today. So I'm filming this before the Fed had made a decision to cut or not cut rates. I do believe that we're going to get a 25 basis point cut, but the comments when Jerome is going to speak are going to move the market. Plus we're also getting the dot plot, which could show us what we should be expecting for 2026 when it comes to further cuts. Now in today's video, I do want to touch on the other side of things, is less focus on what happens with the market, less focus on macro, more focus on staying invested, not staying invested, trying to time the market, not timing the market. We've talked about that, especially closer to the April period, the 10 best days versus the 10 worst days, and what the combination of both will give investors. We also have, of course, comments from Tom Lee. So let's focus further on that. If you enjoy this type of videos, hit all the buttons. We really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, quick overview. Right now, this is what the market looks like. It was a bit worse when the market did open, but as always, it opens either better or worse. And then the first hour or two, we really have some more moves. Then yes, today is a specific day with the rate cut, the FOMC meeting, plus also Oracle's earnings report after the market closes. And so right now, if we look at a couple of names here, fintech-wise, we have more than 50% of the names that we follow that are green right now. Neoclouds, they're all red across the board, whether it's CoreWeave, Iron, Nebius, Applied Digital, doesn't matter. They're all red today, but they're basically back to prices not seen since either yesterday or a couple of days ago. As for the chip stocks, Marvell is the one that's up the most. Then we have Qualcomm, Micron, TSM, Applied Material, CLAC. Then we have AMD, ASML, Nvidia, they're all down a little bit. Then as for the big tech companies, we do have some green, not much. Amazon is green, Tesla and Google, and then the rest is a little bit red at the moment, with Microsoft down 2.6%. As for the other names out there, we do have some names, for example, like a Mercado Libre, which we talked about in the stream, that went down under $2,000 per share. I personally didn't see any specific news that would pull this stock down even further today. I still view this as an excellent company going forward. We have Oscar that's down here a little bit. Uber is down probably because of the quick expansion of Waymo, but Uber has also shown us incredible numbers over the last couple of days. So we are seeing some volatility. The VIX is up a tiny bit today as well. But again, to me, nothing has changed. I do see a lot of comments and chat ask about, oh, why is this stock down? Why is that stock down? But I never hear the question, why is that stock up? Because when stocks go up, people don't usually ask questions. The questions do come when the stocks start to pull back a little bit. Now let's listen to what Tom Lee had to say, especially with regards to the current situation, ending the year, maybe looking forward to 2026 as well, here talking about the 10 best days.
So let me start with some macro. And I want to emphasize something that we've talked about at Fundstrat in the past many times, which is called the 10 best days, or the rule of 10 best days. And to give you some context, I think it explains why people are bearish this year. In fact, if you're bearish this year, you are consensus. Currently, the bulls less bears, according to AAII, stand at minus 10.7. And if you look at the weekly reading for AAII all year, bears have dominated market sentiment all year. There have only been 12 weeks where investors have been positive. Now, why is that? I think it has to do with the fact that people have been trying to time the market. The rule of 10 best days states that the S&P makes most of its annual gains in just 10 days. And it means don't time the market. And this year was a really stark example. Since 1928, the S&P's returned 8% a year. Excluding the 10 best days, though, it's minus 13%. That means you missed out on 2,100 basis points if you didn't own the 10 best days in every year. Since 2016, this rule's also held. The S&P's returned 14%, but it's minus 9% if you don't have the 10 best days. That's 2,300 basis points a year. All of the gains basically in the market are made in 10 days.
Now, I know what people will say, yeah, but you're only showing us what happens when you miss the 10 best days. But what happens when you miss the 10 worst days? Well, of course, if you manage to miss the 10 worst days, then you are going to be up substantially, and you're probably one of the luckiest investors out there to be able to miss the 10 worst days of a year. That's called trying to time the market. And if you're really that good at timing the 10 worst days, then congratulations. But that's not the point. The point, by pointing out the 10 best days, what happens when you are still invested and what happens when you are not invested, that's the point. The point is here, time in the market beats timing the market, because people have tried before, right? People have tried to time the market. Imagine you were so smart to predict the crash in April, you sold everything. And then you said, oh, there is a recession coming, there's a huge crash coming even after, I'm not going to buy anything. Well, we know what has happened afterwards. We've had, 6-7 consecutive months where the market was green. What? You've stayed out for 6 months? No. Smart investors bought during big pullbacks. They bought during the DeepSeek drama. They bought also in April, because guess what? Despite the fact that, yes, macro can have an effect on the stocks that you own, macro can have an effect on the companies that you own, over a long period of time, macro should not be playing a big part in your company's success. You're going to say, yeah, but what if there is a recession that lasts X amount of years? That's probably going to hurt the company. Yes, of course. Of course, if nobody's going to spend anything anymore, if people won't have jobs, if people won't make money, then yes, the companies are not going to be making money either. But as we've seen before, recessions, yes, they do tend to happen, but most of the time, majority of the time, we are in a bull market, we are not in a recession, we are not in a bear market. Let's continue.
Let's just look at the last 3 years. In 2023, the S&P was up 24%. But excluding the 10 best days, it was up only 4. In 2024, the S&P was up 23%. Excluding the 10 best days, it was up only 4%. And this year, the S&P is up 16%, but if you exclude the 10 best days, you're down 12%. Huge difference. So let's look at those 10 best days of every year. In total, the 10 best days in 2025 were particularly stark, 32%. So you really had to be involved in the 10 best days. But that top 10 day was April 9th, 2025, when the market was up 9.5%. So that was the tariff lows. If you missed that day, you've had a bad year. And excluding the 10 best days, the market's down 12% this year. Okay, so it's the tariff bear market that determined everything. Here's the single best day of 2025 right there, that big candle. And if you didn't own it, by the way, after that day, you also missed out on the best 6-month gain we've seen in more than a decade.
Yes, I do hope that makes it clear. Now, if we dive a little bit deeper, we have this chart right here. This guy on X showed us here the top 10 gains and the top 10 losses, right? We've basically talked a lot about the top 10 best days, but what about the top 10 losses right here? If you mix them up, again, you should still be doing okay, all in all. In this case, we have from 1995 all the way to 2025 for the S&P 500. Moving on to the probability part of the video. So S&P 500 after a rate cut, while the S&P is within 1% of all-time highs. We can see that a day later, a week later, on average, we're up, but 44% of the time we were green. So not a lot. 2 weeks later, only 44% of the time we were green, but on average, you're still down 0.1%. But here as well, like the data I've shown you on Sunday, if you look at 9 months later to a year later, we are, of course, up over 93% of the time. Then looking at this, the S&P 500's average forward returns after the Fed cuts rates, while the S&P is within 1% of the time visualized, this looks like this. And then we have the max drawdown. And the max drawdown, you can see 9 months to a year later, the max drawdown on average is here 8.28%. We've had, of course, huge drawdowns right here. Basically, a year after 2019 is the 2021s, right? So we've had a huge drawdown because of the pandemic crash. And these are basically the reasons why 6, 9 to a year later, the max drawdown on average is so high. It's because of those impacts right here, over 20% drawdown because of that same event. And then of course, when you look at late 2024, you fast forward and you have, of course, the big drawdown from April. Now, what has happened with the S&P after the Fed cuts rates within 2% of the all-time highs? Here, if you look a year out, 100% of the time, we were green. Shorter term period, of course, things are a bit more volatile, but on average, we're still expected to be up. If you look at 2 weeks later, 52% of the time we are green, but on average, we are, let's say, flat to red-ish. And here we get the same drawdown impact. So here is the data. This is the data that we have right now. What has happened before might or might not happen in the future, but at least now you know what has happened before. And if you want, you can use that data to your advantage to make some moves or not. Really depends. Like I said in my Sunday portfolio video, I said, look, I've done my buying. Right now, that's about it. We have 3 weeks left of this year, unless I see really big drawdowns in some specific names. For now, I guess I'll sit in cash to start 2026. But does it change? Does it change my mind on the companies that I own? Whatever happens or whatever will be said today by Jerome Powell? Probably not. Very, very unlikely. And so all in all, that's about it. Yes, it is maybe a bit repetitive what we're saying here, but it's maybe a good thing that we repeat these things time and time again, especially since we have been in a very, very good market for the last 3 years. Could 2026 continue the bull cycle? Bulls will say yes, bears will say no, but they've been saying no for the last couple of years anyway, so that doesn't change much. Just know what you own. Know what you own good companies, and take advantage of irrational pullbacks. That's about it. That's it for me in this video. Thank you all for watching. See you all in the next one. Bye-bye.